The average retiree household in the United States spends $57,818 every single year, according to the Bureau of Labor Statistics. That's the baseline. But Social Security covers only about 40% of pre-retirement income for the average earner. That gap, roughly $34,691, has to come out of your savings. So naturally, every piece of retirement advice you've ever heard says the same thing: cut expenses, stop buying the new car, ditch the warranties, cancel everything that feels like a luxury. And on paper, that math is correct. But here's what that advice leaves out. When you ban every enjoyable purchase all at once, something predictable happens. Around month 6, the deprivation gets loud enough that you book an $8,000 cruise you hadn't planned for, barely enjoy it because you feel guilty the whole time, and then come home and do it again next year. The total spending doesn't go down. It just gets lumpy and guilt-ridden. The real question isn't what to cut. It's knowing which things are worth cutting and what to do with the savings. That distinction is what separates retirees who stay financially comfortable from the ones who swing between tight restriction and impulsive spending. By the end of this video, you'll know how to redirect 5 to 10% of your annual withdrawal into a dedicated account. One where every dollar is already pre-approved for guilt-free spending. That small structural change is the difference between a retirement that feels like a punishment and one that actually feels earned. We start with the first item on the list, something almost every salesperson pushes hard, but wealthy retirees almost never buy. And the math of when that advice is actually wrong might surprise you. You've probably heard this one before. Wealthy people don't buy extended warranties. They self-insure. They have the cash to cover a repair, so they don't pay someone else to worry about it for them. That advice is correct, but only under one condition, and most people skip right over that condition. Let's look at the math on a typical example. You pay $250 per year for an extended warranty on a new refrigerator. The average repair bill, if it breaks, runs around $450. If you have a healthy emergency fund, say $50,000 then, that $450 repair is annoying but manageable. You self-insure, you come out ahead. But watch what happens when the emergency fund is thin. Say you have $10,000 set aside. That same year your fridge needs a repair, your roof develops a leak. Average repair around $1,200, and then your car's transmission goes. That's another $2,400, plus a medical deductible of $1,800. Total unplanned outlay in 1 year, $5,400. Your fixed income doesn't absorb that. $2,500 goes on a credit card at 22% interest. Now, the self-insure strategy hasn't saved you anything. It's cost you the compounding on that $2,500, which works out to roughly $11,000 over the next 15 years. I used to give the never buy extended warranties advice pretty freely. Then I ran the actual numbers for someone with a thin buffer. I was wrong. The right answer isn't never. It's only skip the warranty if your cash cushion is large enough to absorb multiple shocks in the same year. Take Phil and Diane, a couple from Ohio, ages 67 and 65. Their liquid savings total $180,000. They live on a 4% withdrawal, which works out to $7,200 per year. That sounds solid, but it leaves almost no room for the kind of compounding bad luck that actually happens in real life. Not one repair, but 3. They skipped the $250 refrigerator warranty because wealthy people self-insure. They weren't wrong about the principle. They were wrong about whether they met the condition for it to work. The useful rule here isn't never buy a warranty. It's this: know your breakpoint. If your liquid emergency fund, not your portfolio, your actual accessible cash, is large enough to absorb multiple unexpected repairs in the same year without touching a credit card, then self-insure. If it's not, a $200 to $300 warranty on a major appliance is cheap insurance against a cascade. And there's a secondary point worth making. Not all warranties are the same. A $250 plan on a $700 refrigerator is a different calculation than a $3,000 extended service contract on a car. The car contract often isn't worth it. The appliance one might be, depending on your buffer. Check your own breakpoint first. The cut is smart, but only if the math supports it for your situation. The second thing wealthy retirees stop buying? This one is tied to something harder to talk about. It's tied to status, and the numbers are more brutal than most people realize. The new car smell is one of the most expensive things you can buy in retirement. Not because cars are bad. Because of what happens to a new car's value the moment you drive it off the lot. According to Edmunds, the average new vehicle loses about 20% of its value in the first year alone. On a $45,000 vehicle, that's $9,000 gone before you've made your third payment. That's not a fee or a tax, it's just evaporation, and you absorb the entire loss. Now add in the extras that come with buying new, higher sales tax, a higher registration fee in most states, and an insurance premium that's noticeably higher for a newer vehicle. Easily $1,000 more per year compared to driving a slightly older version of the same car. Here's what the math looks like when you rethink it. Say Phil and Diane are replacing a 12-year-old sedan. The new version of their preferred SUV runs $48,000. A 3-year-old version of that same model with 36,000 miles is available for $34,000. Same reliability window. Same expected remaining lifespan. The $14,000 difference, invested in a balanced portfolio earning 6% annually, grows to roughly $26,000 over the next 12 years. That $26,000 is not a small number in retirement. At a 4% withdrawal, it represents $1,040 of additional annual income every single year, just from buying used instead of new. Wealthy retirees understand this not as frugality but as math. They buy the 2 to 3-year-old vehicle because someone else absorbed the steepest part of the depreciation curve. They then hold that vehicle for 10 to 12 years, which means the per-year cost of ownership drops steadily over time. The trap isn't buying a car in retirement. The trap is paying full depreciation on a brand new one when a nearly identical vehicle is available for significantly less. There's also a behavioral piece here. For many people, a new car is connected to identity. It signals stability, success, arrival. And I understand that. But in retirement, the question shifts. The question isn't, what does this car say about me? It's, what does this $14,000 cost me over the next decade? When you frame it that way, the decision tends to get easier. New cars are just the visible part. The next item on this list is sold as peace of mind. But the fine print on what you're actually buying turns that peace into a monthly payment that quietly works against you for years. These two products get grouped together here because they share the same core problem. They were not designed to cheat you. They were designed to earn commissions. The shame of being in one of them is not yours to carry, but understanding what's happening inside them is worth your time. Start with whole life insurance. The pitch is straightforward. Pay a premium, build cash value over time, and leave a guaranteed death benefit to your family. It sounds like two good things at once, protection and savings. The issue is the return. Permanent life insurance cash value typically grows at 3 to 4% net per year. A low-cost, diversified portfolio earning 6% net over 20 years nearly doubles that outcome. For most retirees, not all, but most, the gap is significant enough to matter. Now layer in variable annuities with rider fees. The industry average for total annual expenses on a variable annuity, including administrative fees, underlying fund costs, and optional riders, runs around 2.3% per year. Compare that to 0.3% for a basic S&P 500 index fund from a provider like Vanguard. On a $200,000 position, that 2.27% difference costs you roughly $4,540 every year. Run that over 20 years at a 6% gross return, and the compounding math produces a gap of approximately $160,000 in lost growth. That's not a rounding error. That's a meaningful slice of a retirement portfolio. If you're sitting with one of these products right now, there are 3 reasonable paths depending on your situation. First, if you're insurable and have no special needs heirs who depend on a guaranteed death benefit, a surrender analysis with a CPA is worth doing. Surrender, reinvest the cash value, and move on. Second, if you're medically uninsurable and need to move out of a high-fee annuity, a 1035 exchange, that's a tax-free transfer, can move your money into a lower-cost option without triggering a tax bill. Third, if you genuinely need a guaranteed death benefit for a dependent who cannot manage money independently, keeping the policy may be the right call. That's a legitimate reason. It's not the reason most people are in these products, but it exists. The practical test is simple. Ask, who benefits most from this product? Me or the person who sold it to me? If you're not sure, that's worth sitting with. Comment sections are full of people saying things like, I was talked into a whole life policy for my kid, and I feel foolish. That feeling makes sense. But folly isn't the same as failure. You can move from where you are. Now that we've cleared out the expensive protection, let's talk about the hidden fee. The one so small you barely notice it each year. But over time, it steals more than most of the things we've covered so far. This one is the quietest fee on the list. You don't get a bill for it. It just comes out of your returns before you ever see them. And because it's expressed as a percentage rather than a dollar amount, most people genuinely don't know what it costs. The most common fee structure for a traditional financial advisor is 1% of assets under management per year. On a $500,000 portfolio, that's $5,000 per year. That number alone sounds manageable. The problem isn't the annual number. It's the compounding cost of that number never showing up in your portfolio. Run the math over 25 years at a 6% annual return, and that 1% fee, $5,000 per year, reduces your ending balance by roughly $290,000 compared to what you'd have in a no-fee equivalent. That $290,000 doesn't disappear all at once. It disappears $5,000 at a time, silently, every year, compounding into a gap you only fully notice when you look at the end number. For Phil and Diane, paying 1.2% on their portfolio means over a 25-year retirement that fee economy represents $290,000. Put another way, that $290,000 could fund 14 years of the guilt-free spending system we'll talk about in a moment, at $20,000 per year. This doesn't mean financial advisors have no value. Some do, especially during complex transitions, selling a business, managing an inheritance, navigating a divorce. But a blanket 1% annual fee for holding a portfolio that could be managed with a simple 3-fund index structure is a different proposition. The alternative that wealthy retirees increasingly use is a fee-only, hourly planner. You pay for a one-time retirement plan review, typically a few hundred to a couple $1,000s, and then you manage a straightforward index fund portfolio yourself. You might check in with that planner every few years. You keep the rest. If you're within 10 years of retirement and you're paying a percentage fee on your savings, consider running the actual math on what that's cost you so far and what it will cost over the next 20 years. That calculation tends to be clarifying. But I've saved the most important piece for last, because all of these cuts are meaningless if you don't also address the psychological trap that turns retirement into a financial tug-of-war with yourself. Every retirement plan I've ever seen has a savings rate, a withdrawal rate, and a projected end balance. What almost none of them have is a line item for the fact that you are a human being who worked for 40 years and is allowed to actually enjoy their money. And when that line is missing, something predictable happens. You cut everything that feels frivolous. For the first several months, it works. You're disciplined, you're building confidence. And then around month 7 or 8, the pressure releases all at once. You book an expensive trip you hadn't planned for. You renovate the kitchen on a whim. You spend $6,000 on a cruise you're too guilty to enjoy. Come home feeling like you failed. And then repeat the pattern a year later. The psychologists call this the restraint rebound effect. When you suppress a desire long enough, it doesn't disappear, it builds. And when it finally releases, it tends to release past the point you intended. This is not a character flaw. You've worked hard for a long time. You're supposed to enjoy this. The problem isn't wanting to spend. The problem is spending without structure, which turns pleasure into guilt, and guilt into more restriction, and more restriction into another blowout. I had a client a few years back, disciplined guy, good saver, careful with everything. His wife cried because he wouldn't allow a $300 anniversary dinner. He wasn't being cruel. He was being afraid. He thought the only way to protect their retirement was to tighten every valve. What I eventually told him was this: the problem isn't the $300 dinner. The problem is that you have no system that tells you when spending is okay. So every purchase feels like a threat. I used to say, cut every subscription, drive the car until the wheels fall off, never buy the latte. I was helping people die with more zeros but live with less life. That year, I started building a different line into every plan I wrote. The Joy Bucket. Here's how it works. Take your annual withdrawal. For a $800,000 portfolio at a 4% withdrawal, that's $32,000 per year. Multiply by 7%, right in the middle of the 5 to 10% range. That gives you $2,240 per year, or about $187 per month, that sits in a completely separate account. That money has one rule: spend it. Not on bills, not on repairs, on whatever brings you actual pleasure. A pottery class, golf weekends, a nice dinner, a weekend with your grandkids. It doesn't matter what. The label on that account is no guilt. When it's gone for the year. There's no shame and no asking permission. You've already pre-approved it. The budget is the permission. Now, someone watching this will say, if I cut the Joy Bucket and keep that $2,240 invested instead, doesn't my portfolio last longer? Technically, yes, by roughly 1 additional year over a 30-year retirement horizon. 1 year, in exchange for 30 years of treating every purchase as something to be defended. The portfolio math slightly favors skipping it. The actual life math does not. Here's how to set this up. First, determine your annual withdrawal using the 4% rule, or 3.5% if you want to be more conservative. Second, multiply that number by 0.05 to 0.10. That range is your Joy Bucket. Third, open a separate savings account for it, separate from your emergency fund, separate from your main spending account. Transfer the monthly amount in automatically, the same way your bills come out. Fourth, spend it entirely each year. Not some of it, all of it. That's the rule. Fifth, at the end of each year, look back not to judge the spending, but to calibrate. If you consistently have money left over, lower the bucket. If you're regularly dipping into other funds, raise it from other cuts, not from your core portfolio. The Joy Bucket doesn't cost your retirement. It funds it. But before you think this is all about spending freely, There's one more category that wealthy retirees cut almost immediately, and it's the quietest drain on the list. This last one doesn't feel dramatic. It never does. That's exactly why it stays on the list for years. The average monthly cost of a storage unit in the United States is around $180 according to industry data from 2025. That's $2,160 per year. At a 4% withdrawal rate, maintaining that unit requires roughly $54,000 in your portfolio just to cover it indefinitely. $54,000 sitting there in savings, paying for a unit full of things you most likely haven't looked at in 3 years. Wealthy retirees close the unit. They sell or donate what's inside, and they free up that $2,160 per year. Depending on your situation, that either extends your portfolio by more than 2 years, or it goes directly into the joy bucket. Unused subscriptions work the same way. Streaming services you forgot you signed up for, magazines that go unread, meal kit services that stop making sense when the kids left home. Averaged across a household, those unused subscriptions add another $1,200 or so per year. Combined with the storage unit, you're looking at roughly $3,360 annually, about $84,000 in required portfolio value, going toward things you no longer use. This is the dripping faucet. Not dramatic, not emotional, just steady and consistent and worth turning off. When you add it all up, the warranties you don't need, the new cars, the expensive insurance, the advisor fee, the storage units, and the forgotten subscriptions, you're looking at $8,000 to $15,000 in annual savings opportunities. The joy bucket costs a fraction of that. The rest stays in your portfolio. So here's where we landed. Check your cash buffer before deciding to self-insure minor risks. Buy used cars and hold them long. The depreciation math is clear. Drop the whole life policy or high-fee annuity if it's not serving a specific need in your plan. Fire the percentage advisor and replace them with a flat-fee planner and a simple index portfolio. Close the storage unit and audit the subscriptions. But do all of that to fund something, not just to reduce a number on a spreadsheet. Use the savings to build the joy bucket. 5 to 10% of your annual withdrawal, pre-approved, guilt-free, fully spent every year. That's the structural fix that keeps the cuts from becoming restriction and keeps restriction from becoming a blowout. If you're one of the millions of Americans within a decade of retirement who wants a plan that lets you enjoy your money without worrying it will run out, subscribe now. Every week, I cover the real numbers behind the decisions that shape the quality of your retirement. Not just whether you'll make it, but whether it feels worth it. I don't know every detail of your situation, but I do know this. A retirement built entirely around fear of running out will never feel free. The joy bucket is the math that gives you permission. Use it.